In this example, we'll be using practice exercise 16.3b that can be found in your textbook on page 756. We're going to be looking at the changes in our current operating assets and liabilities, again using the indirect method that will be found in our operating activities section of our statement of cash flow. They tell us that our corporation's comparative balance sheet for current assets and current liabilities are as follows. They then tell us that we need to adjust a net income of $160,000 for changes in those operating assets and liabilities to arrive at our net cash flow from operating activities. In our operating activities section, which is the first section that we do on our statement of cash flow, is we start with net income. In this problem, they tell us our net income was $160,000. Remember, net income does not reflect cash, and that is what we're trying to get to here. Net income includes revenues that were done on account and expenses that had no cash impact. What we always do first are for any adjustments to reconcile net income to net cash flows from our operating activities. This would be where we'd include any expenses that have no cash impact that are on our income statement, and any gains or losses on the sale of non-current assets that would be handled in our investing section. We don't have any here in this case, so we can move right on to our changes in our current operating assets and liabilities. Here, we're going to compare our current assets and liabilities from last year to this year to see if they have increased or decreased. Remember, this is a statement of cash flow, so we will not include cash here. So in the information given, they tell us that our accounts receivable on December 31st of last year was $14,400. This year, it's $18,000. So we have an increase in our accounts receivable. We now need to figure out how that's impacting our cash flow. When our accounts receivable increases, that means we're going to be receiving more cash, but not now, sometime in the future, which means that we're either collecting cash slower from our customers on account, or we're doing more business on account than we're doing with cash sales. So when our accounts receivable goes up, our cash flow, meaning the cash that's flowing into our business, is actually going to decrease. So we'll take last year's balance of the $14,400 and subtract away this year's balance of the $18,000. Therefore, our increase in accounts receivable is actually having a negative $3,600 impact on our cash flow. Remember, as accounts receivable goes up, there's no cash exchanging hands. The next one is our inventory. And they tell us that last year we had $29,700 as a balance in our inventory, and this year we have $34,800. So again, we have an increase in this asset, meaning that we've purchased more inventory, but we're not selling it as quickly. Therefore, our cash is being tied up in our inventory. So again, we look at our last year balance of $29,700 and we subtract away this year's balance of $34,800. And again, the increase in an asset is going to have a negative impact on our cash flow. When we finally sell the inventory, we'll likely get cash for it. But the more we buy and store, our cash is being tied up in that inventory. The next one is our accounts payable. Last year, it was $20,700, and this year, it's $27,600. So we have an increase in accounts payable. Again, let's determine the impact that will have on our cash balance. The more that we purchase on account, the less cash we're spending now. Think about if we purchase supplies on account. Our journal entry would be a debit to supplies and a credit to accounts payable. There's no cash involved in that transaction. We're able to hold on to our cash for a longer period of time. Sometime in the future, we'll actually have to pay off that accounts payable, but for now, we don't. Think of it as the difference between using your debit card to purchase your textbook or your credit card to purchase your textbook. If you go to the bookstore and you use your debit card to purchase your accounting textbook, your checking account immediately goes down. You're losing cash. But if you use your credit card, nothing happens to your checking account. You will just have to pay that credit card off at a later date. Therefore, any increase in a current liability actually increases your overall cash flow. So we'll take the current year balance of $27,600 and subtract away last year's balance of $20,700. It's having a positive cash flow impact of $6,900. The last one is dividends payable. Although this is technically a current liability, we will not handle it in this section. The reason for that is we pay dividends to our stockholders. Our stockholders are a financing activity. Again, we finance our business through debt and through equity. If we are paying dividends to our stockholders, that is a financing transaction. So we will then add together our increase in accounts payable, our increase in inventory, our increase in accounts receivable, and our net income to arrive at our net cash flow from operating activities.